Okay guys, welcome back to the channel. So let's get right into this. I recently came across this ETF ticker SVOL or Svol, which is the Simplify Volatility Premium ETF. And if you scroll through this, you're going to see things like the expense ratio, it's 0.54%. It has about 100 million in assets under management. And oh yeah, the dividend yield is 18.5%. And if we come over to Seeking Alpha, we can confirm this by going to the dividend page, and the yield currently is 19.15%. And if we come to this page, we can see they pay this out on a monthly basis, and each dividend payment is about 35 cents per share at the moment. So when it comes to this ETF, it is very different than, I'm going to say, every other ETF you've ever seen before in your life. So let's go ahead and read the overview. So the Simplify Volatility Premium ETF, SVOL, seeks to provide investment results before fees and expenses that correspond to approximately 1/5 to 3/10, so -0.2 to -0.3, the inverse of the performance of the S&P 500 VIX short-term futures index, while also seeking to mitigate extreme volatility. And it goes on to say that in the current market situation, this could be a valid source of income in the market. If we look at the key points over here, we can gain some more knowledge. So this is the first ETF providing inverse VIX exposure coupled with a dynamic hedge. So it's kind of twofold in the way that it operates. Now the ETF only has about 25% short VIX exposure, and it helps to balance trade-off between high income and volatility drag. And then this point here is the dynamic hedge. So what it is they have deep out-of-the-money VIX call options, seek to provide low-cost protection against extreme VIX spikes. Okay, so where to start here? So obviously this is a very specialized strategy. It's not something that everybody should just invest in. The main perk of this investment is that it adds a very alternative source of income to a greater portfolio if that's something you want. And generally speaking, for now, it acquires this income through volatility premiums. And the document mentioned the VIX multiple times, and this is a general measure of fear and volatility in the market by option prices. And you can view both call options and put options as a type of insurance you can buy for stocks. And using that logic of the insurance analogy, during times of high volatility, we can see the insurance premium, quote unquote, spiking. And that's why this can be viewed as a measure of volatility in the market. Now, the whole concept of using volatility to your advantage and generating income is not a new concept. In fact, I do this currently in my portfolio through much more simple ETFs like qyld. And this ETF sells call options or that insurance on the S&P 500, and it pays out the premiums back to the investors in the form of monthly dividends. And if we take a look at the actual dividend payments from qyld, we can see that over the past couple of months, with the high level of volatility, that has enabled this ETF to generate the highest dividends on record. So that strategy of profiting off of volatility in the market is a commonality between these two funds, but that's about where the similarities end. Everything else is extremely different. So I'm going to go ahead and read some of this article on this ETF to try and paint a picture of what's going on here, and I'll leave the whole article linked down below. And if you guys have any input on this, any opinions, please leave a comment and share your thoughts. Okay, so Svol sells shorts, and it does that through an ETF, the ProShares Short VIX Short-Term Futures. Something to note about SVXY is that it's only 50% short the VIX, not 100%, and it does that as a risk mitigation measure. On top of that mitigation, SVOL only invests about 50% of its capital into SVXY to begin with. The rest is in short-term treasuries to help limit risk even further. So putting that together, you have roughly a 25% short position in the VIX. Now this ETF is less than 1 year old, but here they give an example that during this time period, shorting the VIX would have led to returns of over 2,340%. And Svol in particular, in that situation, would have returns of around 500%. But there are many situations where Svol can suffer significant losses, and Q1 of 2020 is a great example of this, because of course the volatility spiked in March of 2020, and this shorting strategy suffered because of that. So to further reduce these losses, Svol invests about 1% of its holdings, buying deeply out-of-the-money call options on VIX futures. The payout profiles of these options is such that the profits are quite high if the VIX skyrockets, which is when shorting the VIX causes significant losses. The call options are meant to act as a hedge against shorting the VIX. So you you can tell this ETF is far more complicated than something like qyld, even though they both leverage volatility to help boost returns in some way. But all of this complexity and risk does have a purpose behind it, and that's to achieve an absolutely insane monthly dividend. And for fun, if you want to compare this number against the yield in qyld, they currently have a monthly dividend of 12.3%, which is still high, but in a completely different world than Svol. Now, to finish off the video, I also want to read some of this article, which I'm also going to leave down below. And this is all about, is now a good time to be investing in this ETF? And it gives a good little summary of the current situation. So the short answer is most likely. So since inception of May 2021, Svol is near an all-time low. Recent volatility due to inflation concerns, Omicron, stretch valuations, and Russia have caused the VIX to increase to much higher levels. In the last year, the VIX closed below 25 90% of the time and below 30 98% of the time. In the past month, it has closed above 30 12.5% of the time. Therefore, it has been a comparatively volatile month, and given its mean reversion nature, volatility should begin to settle down. Right now, the VIX futures term structure shows the market is pricing in lower volatility in the future. At such elevated spot levels, traders do not expect the VIX to continue at this heightened state. If the VIX returns to what it was 90% of the time in the last year, which is 25 and below, this would mean significant returns for the short March contracts and continued positive returns for April. The only risk is that volatility continues to increase. And the author goes on to say that this is pretty unlikely because it will mark a new market regime, because volatility levels have never historically been this high for such a long period of time. But of course, there are ways it could happen. The second and more likely outcome is that in the next few months, something could happen. So COVID, inflation, Russia, that causes the market to experience extreme volatility. So if this worst case scenario does happen and the VIX surges over 60, Svol suffers large drawdowns, although it will probably be no more than 50%, most likely no more than 30%. Volatility, however, cannot stay at extremely high levels for long. The short volatility strategy will succeed as markets inevitably settle down. Thus, a VIX over 50 would be a sign to buy. So that's Svol, an extremely unique ETF that's all about generating extremely high levels of income by shorting volatility in the market, which is extremely risky, but has a massive payout if done correctly. Definitely leave a comment down below on what you think of this ETF. I'll be very interested to know. If you guys are still watching and enjoyed, I appreciate a like on the video. Go ahead and subscribe, and I'll see you guys in the next one.